The idea for this video was simple: explain the world's most complex casino and why it's on the edge of complete collapse. Some of you may remember 2008, but if this theory regarding the world's derivatives markets is correct, then the 2008 Great Recession will become a footnote in the history books. If this house of cards is as tall and unstable as is claimed, we may be living in a world that is primed for complete financial destruction. Now, before I start, I want everyone to be fully aware that this video is 100% inspired by this post made by Reddit user Cryand. His theory, labeled The Bigger Short, received 60,000 upvotes, and it attempts to summarize a theory which states that the market crash of 2008 never really finished. The story begins back in the 90s with the derivatives market. This was considered by many the opening of the literal casino in the financial world. If you don't know derivatives, they come in many forms in finance. One that many of you are probably familiar with are call and put options. Others include forwards, swaps, CDOs, and CDSs. I can make an entire 3-hour video on just derivative basics, but think of them as investing, or in my opinion, gambling on steroids. There is an entire industry that has emerged dedicated to making massive bets on financial instruments. Bets that have been disguised as investing, but to many look more like a blackjack or slot machine in a Vegas casino. Warren Buffett had an amazing comment in regards to the rise of the derivatives market, close to the time when it was originally created. Pay close attention to what he said back in 1995.
The potential is huge. I mean, you can do things in the derivative markets. Well, I've used this example before, but in borrowing money on securities, the Federal Reserve and the U.S. government decided many decades ago that society had an interest in limiting the degree to which people could use borrowed money in buying securities. They had the example of the 1920s with what was 10% margin, then was regarded as contributing to the Great Crash. So the government, through the Fed, established margin requirements and said, I don't care if you're John D. Rockefeller, you're going to have to put up 50% of the cost of buying your General Motors stock or whatever it may be. And they said that maybe Mr. Rockefeller doesn't need that, but society needs that. We don't want a bunch of people on thin margins gambling, essentially in shares where the ripple effects can cause all kinds of problems for society. And that's still the law, but it means nothing anymore because various derivative instruments have made 10% margins of the 1920s, look like what a small-town banker in Nebraska would regard as conservative compared to what goes on. So it's been an interesting history.
So there you have the great Warren Buffett warning us of the potential these financial instruments have in ruining society. His partner, Charlie Munger, adds to this even further, explaining just how terrible these bets can be if they're allowed to spiral out of control on Wall Street. Listen to his comment as well, and afterwards, I'll show you exactly how these statements relate back to what is happening today. Let's just say we are living in shocking times.
Well, I disapprove even more than you do, which is hard. If I were running the world, we wouldn't have options exchanges. The derivative transactions would be about 5% of what they are, and the complexity of the contracts would go way down. The clearing systems would be tougher. I think the world has gone a little bonkers, and I'm very happy that I'm not so located in life that I have to be an apologist for it. A lot of these people, I feel sorry for them. They had great banks, and they have to go before people, sometimes even including their children and friends, and argue that these things are wonderful.
So what does all of this have to do with this great theory that claims the entire market is going down? Well, if we take a look back in time, people actually listened to Warren back in 1995, and various attempts were made to regulate this portion of the market. However, in 2000, President Bill Clinton, with the pressure of various lobbying groups, passed the Commodity Futures Modernization Act. It was essentially a law that completely deregulated derivatives, setting us up for the greatest house of cards in world history. Wall Street began making tons of risky bets and surging their profits. By the end of 2020, the derivatives market was so big, the nominal value topped $1 quadrillion. To put that into perspective, 1 million seconds is 11 days. 1 quadrillion seconds is 31.7 billion years. The derivatives market is actually bigger than all of the world's real estate put together. The number behind it is simply mind-boggling, and I'm not sure if any comparison does it justice. There is just no good way to show the sheer scale of the problem. But maybe you're thinking, well, what's the issue? How is this going to cause another massive crash? Well, there are a couple of theories, but this one focuses on commercial real estate, something that is often ignored as we tend to focus on residential, as it was the source of the last crash, and it directly affects our lives. Most Americans are homeowners, but commercial real estate is showing troubling trends, and it all comes back to these derivatives, as I will show you in just 1 second. In fact, many billionaires are now actively shorting certain commercial debt by using something called credit default swaps, a derivative made famous by the movie The Big Short. These were the same financial instruments used by Michael Burry and others in the movie in their case to bet against the housing market. Billionaire investor Carl Icahn is now using them to bet against something else. Check out this news report from late last year. But before I show you, consider hitting that subscribe button if you're enjoying my content. Now back to the video.
Billionaire investor Carl Icahn is betting against struggling mall owners. His $400 million short puts him up against some of the largest money managers in the United States. We want to turn to the panel on this one. Traders told the Wall Street Journal that this puts Icahn as the largest short seller of mall debt.
So there you have Carl Icahn betting big against mostly malls and making billions as of the latest updated evaluations. And this all brings us back to the original Reddit post. Right about halfway down, we have a section called Abuse of Commercial Mortgage-Backed Securities. This portion claims that big banks like Goldman are inflating the values of commercial businesses, reporting falsified income data that compromises the integrity of the resulting securities. That is a very complex way of saying they're lying about the health of certain commercial businesses in order to make it appear as if they're giving these companies healthy loans. Just like mortgage-backed securities from 2000 to 2007, the loaners will go around, hand out loans to businesses, and rake in the profits while having no concern over the potential for these subprime loans failing. This information is based on an article from The Intercept, which is linked in the description below. Now, to make matters worse, the pandemic has accelerated these problems. There is so much leverage abuse in the world, all it takes is one fatal blow to bring everything down. In fact, the author of the post claims that the pandemic has already started the fire, but the Federal Reserve is sort of just hiding it for now. You'll see what I mean as I further explain. Basically, when the pandemic hit, delinquency rates of commercial mortgages began to skyrocket. They even surpassed 2008 levels in March of 2020. Remember what happened in 2008 when this occurred? When delinquency rates went up on mortgages in 2008, the CDOs of those mortgages began to fail. But this time, they can-kicked it because COVID caught them off guard. In order to buy time, the Federal Reserve and Treasury began tossing out emergency relief protections for the economy, such as preventing mortgage defaults, which would send their CDOs tumbling. The moment these protection plans lift, we can expect to see a surge in foreclosures as delinquency payments have accumulated over the past year. Now, you may be thinking this is all fear-mongering, but there is a data point that shows exactly why everyone is suspicious this is the case, and it's something called the SLR requirement exemption. The initial move, announced April 1st, 2020, allowed banks to exclude treasuries and deposits with Fed banks from the calculation of the leverage ratio. Now, this may sound very confusing, but essentially this move is said to be proof of the underlying issue. This, according to many, is a big sign that banks are way over leveraged. The SLR protection ended on March 31st, 2021. And guess what happened right after? The reverse repo market started to explode. Now, why this is happening as a result is actually really hard to explain in a short video just like this, but you can read more about it by going over the original Reddit post and Googling reverse repos. The claim is that these are exploding because banks are having a hard time meeting SLR requirements, the same ones that were brought in to control and cool down the banks from getting greedy. Now, to finish off the theory and provide one last bit of proof, the author goes into some of the recent DTC, ICC, OCC rule changes. Basically, a lot of them read like preparation for a massive power scoop by big banks, allowing members to scoop up assets of other defaulting members, the same way JP Morgan bought up Bear Stearns for $10 a share in the financial crisis. In other words, it's more concentration of power, less competition. In summary, this video doesn't do the actual post justice. It would actually take much longer to go over all the details outlined in this infamous Reddit post, and I encourage everyone to read it. If this is true, it will undoubtedly shake up American history and further consolidate power to the major banks. In the meantime, if you're looking to diversify your holdings and maybe buy up some crypto as a way to protect yourself against the ludicrous derivatives market explosion that may bring down the entire stock market, please consider signing up for BlockFi using my affiliate link down below in the description. I currently keep about $5,000 worth of stablecoins, bitcoins, and Litecoin using their service, and the good news is that if you choose to use my link below, you will get up to a $250 crypto bonus with a deposit of $100 or more. This is a great way to earn some yield on your precious cash and crypto holdings. Thank you guys for watching, and please make sure you hit that subscribe button if you enjoyed.